Good evening, friends. This is Sumant. I'll be the host for today's session. Today's topic is price structures, and we'll be introducing you to demand and supply. Okay. Before we get into the session, please go through the disclaimer once. All right, friends. Today's topic is introduction to demand supply, and we'll be discussing, how what are the different price structures today. What's important today is, today's session will contain a bit of a theory, but we couldn't avoid it, and we have to have it so that you get some intricate details that would be informative for you. Okay, so kindly need your attention today, and as we go through each of the slides before we get to the price structures actually. Okay, I hope you like the session today. Let's move forward. Market participation, right? So in market there are different people participating in the market, as we all know. Okay, so let's see what we have in market participation. With millions and billions of volume happening in our stock market, it is important to know who all are creating this volume and price movement. Right? Broadly speaking, the market participants can be distinguished as institutions and retail traders. So we all know that there are big participants called the big boys, right? Who we also call them as institutions in the market. And second set of participants are generally called as retail traders. Right? They call retail traders because they are nothing more than common traders, common people who want to earn something from the market. Okay, and who are also driven by emotions, right? Emotions in the market, and institutions are those who are considered to be professionals in the business of trading. Okay, institutional traders are the ones who have huge corpus, and these traders have the ability to move the market since they place huge amount of buy or sell orders owing to their large corpus. Right? I hope this line defines what institutions are. Right? First thing is they have the ability to move the market, right? Because they have huge corpus, and using that they can place very huge amount of buy or sell orders. Right, friends? That's what defines institutions, in summary. And institutional traders include FIIs, DIIs, HNIs, banks, mutual funds, insurance companies, syndicates, operators, etc. Right? Can you relate to all these people having huge corpus and who are having concentrated efforts, who are putting concentrated efforts on certain scripts, and who are interested in driving the price up or down in a script, thus making huge money, isn't it? On the other hand, there are retail traders who do not have the luxury of such high corpus, but do have high degree of greed and fear. I hope this line summarizes who retail traders are with respect to institutions, isn't it, friends? So can you make out the huge variance between the institutional market participants and the retail traders? Okay, first thing comes with huge corpus, right? Second is institutional market participants are highly professional, right? And retail traders are those who have high degree of emotions called greed and fear, right? And the biggest minus is here they don't have the luxury of a huge corpus as the others. So what does that signify other than this, friends? As a difference between institutions and retail traders. One is the corpus, right? And what's the other? Apart from greed, apart from emotions, what does retail traders do not have in their power? Can somebody spot? Okay, Anshul says inside information. All right, right in a way. Exactly, Hemant. Hemant says moving market in their favor. Exactly. That's the point, right? So, because retail traders don't have the luxury of high corpus, right? And they may also not have the professional expertise to participate in the market, right? But even if they have professional expertise, they may still not be able to move the market because they don't have the luxury of huge corpus like the institutions, right? So who becomes more powerful by the very definition of institutional versus retail traders here? Institutions, exactly. So the retail investors can further be classified as the novices, that is general public, who have just entered the financial markets and have little to no experience of the tricks played by the institutions, right? And they are very gullible and highly emotional with greed and fear. So how many of you can relate to ourselves to which category of the market participants largely? To the institutions or the retail traders? Yeah. And retail traders also constitute of fairly experienced ones who knows the tricks to some extent, and instead of getting trapped, they take advantage of the tricks played by institutions and eventually trade with the institutions in their direction to some extent, right? Underline, eventually trade with institutions in their direction to some extent, right? And even technical traders fall in this category to an extent, right? So though we may also be fairly experienced in knowing their tricks, right, and trying to play along with them, with the institutions, we generally end up in trading in their direction to some extent, right, but may not be able to participate in the entire journey with the institutions. That's what this this definition summarizes. Can anybody tell me, friends, why would that happen? Why would that be? Exactly. Greed or fear, right? So institutions are the ones who have perfect designs, right, in the market, how to move the price, where to move it, from where exactly to turn it, how much to move it, right, and how much more to take it up or down, right, and how long with respect to time that this process needs to be taken forward, isn't it, friends? So it's entirely a game that requires a lot of mastery, patience, and perseverance, okay, along with huge corpus to be sustaining that kind of mobility of prices with respect to time in the market, right? And that is how the professionalism comes into play, and less of emotions come into a picture, isn't it, friends? So even if retail traders, like they're even learning the tricks of institutions and looking to play along with them, they may or may not sustain the entire move, like up move or down move that institutions are playing in the market. Like we may not be able to take the entire pie that which the institutions are playing the game fully with, right? Because we generally end up in greed or fear when price moves are huge, huge against us in the opposing direction, isn't it? So can you make out the difference, right, of classification of the market participation here? Majorly, right? So secondly, having understood the very fundamental definition, the distinction between institution and retail tellers, on whose side would all of us would like to participate with? On whose side would all of us like to participate with? Institutions, right? And why would we want that to be done? Why do you think so? For profit. Yeah, make profit. All right. See, even retail traders are making profits, right? Even retail traders must also be making profits in their own way, isn't it? Yeah, exactly. Because institutions, they have huge corpus and they drive prices like crazy, right? So if we are able to, right, learn some ways in which we can participate along the side of institutions, right, like it is also described here, like even if we get those knowledge, we may not be able to capture that entire move, but yes, but if you are able to trade along with them, we may get the a good amount of pie of that move, isn't it? Even that could enhance the trading style of us being retailers, right? From being little different than the other retailers, but to play alongside institutions and get a better pie than the ordinary retailer, isn't it, friends? Does that make sense? Yeah, great. So in this course, we will teach you some of the tricks to identify institutional order flow, which you can cause, which you can use to your advantage to be able to trade with them. All right, wouldn't that be nice? All right. So institutions, again, I want to ask a question. Why do we care? Right? Why do we care so much about institutions? Because they consist of professionals with profound knowledge in markets and they are well informed. Somebody just said about insider information, right? Insider information is also something to do with being well informed, right? And not only that, they are well informed of events that are going to happen much in advance, right? Because they have professionals, right? Financial professionals, etc., whose job is to professionally do the analysis, right? In parallel to the financial market drivers, right? Even the big institutions like the RBI, right? Who brings in the policies, isn't it? So they have some ways to identify, to capitulate a lot of data, right? That can give them some indications of how well the market is poised, how well the economy is poised. So they can take steps much in advance than everybody else can. Isn't it, friends? Yeah. So that's one of the reasons why we would want to care about institutions. We can't take them lightly. We have to take them very seriously. Right? Yeah, Pardeep Sharma says, and they might be aware about RBI policies before announcement. Yes, Pardeep, all that happens because they also feed in a lot of people for insider information. It happens not only with the institutions like RBI, but also with a lot of companies where they are interested to invest in, or they are already invested into. Right? So that's how they are able to consistently plan well ahead of everybody else who's participating in some scripts or in the market, so that they can make some moves well ahead. Right? Like supposing RBI policy, right? If it's turning into negative, they may want to turn the price to little higher area well ahead of it, so that they can sell the market from a higher price point. Right, friends? So for that, planning needs to be done a little bit in advance, so that the price can be moved to a higher area. To make what? To make huge profits when they sell it. Right? Similarly, when they think, the economy is on the turn, so before it is going to turn to better, it always go to a worse, right? And since they are well informed, they can predict the moves in advance, right? And start accumulate the stocks at particular price points. So when economy turns, right? The market cycle turns, they can turn the price of the stock too, and they can make huge profits, taking the price up from the lower area. Friends, have you understood? Yeah. Secondly, since they have large corpus, so their orders are also huge, and thus eventually huge order flow moves the market. So large corpus means large orders, which is nothing but a huge order flow that makes them market movers. Fourthly, they are high risk takers and aggressive players. Right? Institutions are high risk takers and aggressive players. Why, friends? Because they have very high stakes at play. Right? So just imagine you're putting a large corpus of money into the market with some calculations, right? So what do you think, friends? Does that make them conservative players? Does that make them conservative players or aggressive players? Can somebody tell me? Aggressive, yeah. Not just aggressive, highly aggressive players, right? And that always comes with high risk, isn't it, friends? Because they are betting they're betting their entire stakes at play. But the important point here is, friends, when they bet such high stakes to play, they always bet to win. Right? So when they bet, you can be sure that there is a highest probability of them winning the move, right? Because they would do anything to win that bet. So that again makes us to care about them, isn't it? So if you are playing alongside institutions, friends, right, who are betting very hugely to win, right, then your odds of winning also increases, isn't it? And that's why it is important that we must learn to identify the institutional behaviors and trade along with the institutional order flow. When we trade on their side, we can also make big gains, right? That's the point we wanted to make. Thus, eventually, everything boils down to identifying institutional order flow with the help of supply and demand and price action. So friends, have you all got the point where we are getting into with these slides and why we are getting into? Thing is, learning something is, becomes more easy when you can get to know the very purpose of why you are doing it, right? And even if there is a session where we are actually giving you something about a negative point, right? Let's say there's something called a negative point, called let's say stop loss, or say we saw something about spring, right? So if you are in a position, right, to do a research and understand the process of how something like that happens, which throws you out and gives you a huge profit after you are not in the trade, right? If you're able to understand your enemy, right, does that make you a better participant? Like there are two things, right? Dealing with something without knowing something, right? Like being in darkness. And there's another thing where you are fully aware of what there is around you, and then you deal with the situation. Which one of them do you think is better? Which puts you in a more well-informed situation? Second one, yeah, when you are more well-informed. So when we are going to talk about tricks, right? These tricks are often very deceptive things, and why we want to talk about them is because those are the things which will actually put us into as a what do you call puts you as a victim, right? You become a victim of those, and all the while you may not even be aware that you have been tricked in a certain way. But if you know how exactly the tricks can be played, you can play that even better, right? At least you know that some trick was played with you, isn't it? And then you learn how well you can manage knowing the trick. So similarly, if we can learn some of the behaviors of how institutions play around, right? If you get to know a little bit more about them, their behavioral patterns, what kind of price structures they form on the chart, by each and everything, what they mean by how they are signaling to other institutions, right? So if you are able to if you are able to study all those things and pick up signals, we can be better informed and try to look to play alongside with them, right? So that eventually brings us to identifying institutional order flow with the help of supply and demand and price action, and that's what we will be doing, henceforth in the sessions. All right. Right, now that we're talking so much about the big boys called institutions, let's also see some of other terminologies which are associated with them, right? First thing is how we can classify price from the perspective of institutions. Okay, Pardeep Sharma has a question. Are these institutions are following same pattern consistently? I mean, in next few years, would they change their style? Well, Pardeep, there is a consistent R&D on every side, right? Now, the improvisation would take place, right? Improvisation would not take place as long as at any of the existing patterns that they are forming largely, right? That they are not getting the fills. You tell me why some trick need to be played in the market. Let's understand that perspective first. What is the necessity for somebody to play a trick? Why should somebody play a trick? Okay, to have win-win is fine, right? They need to play a trick because they need their fills, right? Exactly. Fill is the most important thing. You have a buy order and you're not getting the fills. What's the point in pushing the price further up or down? Right? That's absolutely the necessity for anybody to play a trick or to trigger somebody's stop loss, right? So the answer to your question lies in that, right? So if everybody is learning these tricks in the market, right? Like what you're going to learn in this program are consisting of certain price structures which you're going to learn as part of their tricks and to improvise your trading style, right? Now, let's say if there are numerous retailers, huge number of retailers studying these patterns and they're all playing in the market, do you think institutions are going to get their complete fills? Not. Then what should they do? They need to improvise, right? They need to improvise, isn't it? So when they improvise, a certain new patterns may evolve. Right, Pardeep? Hope you got the answer. Yeah. So tell me, friends, how can we classify price from the perspective of institutions? Any guesses? Cheap and expensive, says Anshul, right? Any more answers, friends? All right, let me go ahead. Wholesale price and retail price. Pardeep, we are talking about price classification right now. Right? How do you classify price? So price is majorly classified as wholesale price and retail price. What is wholesale price, friends? What is wholesale price? Very cheap, right? Exactly. And what is retail price? What is retail price? All right. So these are the two price classifications as per the institutions, right? So for them, wholesale price means better product at cheap price. All right. And retail price means not so cheap. That means they are expensive. So tell me, if they want to buy, right? If they want to buy, would they be willing to buy it at a wholesale price or at a retail price? If institutions wants to buy. And similarly, if institution players want to sell, would they be selling at a wholesale price or at a retail price? What would they be interested in? So what do you think, why is something called retail price? Who are they? Who are they selling into? Novices, right? Yeah, the retailers. That's how it's called retail price. Right? They want to buy from the retailers at a very cheap price, right? And they want to sell their product at retail price to the retailers. All right, and for doing that, they play all sorts of tricks. All right, friends, you got the point? So how institutions make profits? So they buy at wholesale price and sell at retail price. And institution profit is nothing but retail price or prices minus wholesale price or prices. So why did I say retail price or prices and wholesale price or prices, friends? Why is it named in multipliers? Any cues from the previous session? I said institution profit is nothing but retail price or prices, right, minus wholesale price or prices. Yeah, and exactly. In accumulation distribution, we talked about buying or accumulation happening at multiple price ranges, right? At different volumes. Similarly, selling or distribution happening at multiple price ranges, right, with volumes. So you need to also link the volume spread associated with the retail price ranges where they bought versus the wholesale price ranges, wholesale price ranges where they bought versus retail price ranges where they sold. Right, friends? Are you able to get this? Exactly. So the money spent for buying at wholesale price is nothing but volume into the price where all they bought, right? And similarly, selling value that happened at retail prices is nothing but volume into the prices, right? At wherever they sold. So that makes it selling price minus buying price, and that's a institutional profit, right? So in order to ensure that they have the maximum profit, what do you think should be the balance of this formula? Simple formula. It's a simple math, very fundamental question, but I just want to ask you so that it registers in our mind, right? Yeah. They need to buy as much quantity, higher quantity as possible at the wholesale price, which is much lower on the chart, and they need to sell as much as possible at the highest portion of the chart so that they increase the the factor of selling to make a huge profit. The difference between the two, right? And that's how they make the profits. Friends, are you all clear with this? Price classification part? Superb. In markets around us, in general, we have retail vendors versus wholesale vendors, and for buying at better prices, we tend to opt for wholesale dealers since they offer products at cheaper price. Okay, Pardeep Sharma has a question. Does it mean accumulation is also created by institutions? Of course, Pardeep. Of course. So we discussed during the accumulation distribution phase that who has such amount of understanding and range fixation knowledge and the kind of patience to be able to fix a range and play all the kind of tricks to be buying in that range of accumulation, right, before price makes its move, right? Similarly, even while distribution, who has that kind of patience to exercise that kind of right? So obviously institutions are playing as market participants in those areas primarily. And those are all very violent areas too, we discussed, right? It involves a lot of corpus to be playing those games there, right? So shall we continue, Pardeep? All right. Similarly, in markets, when we intend to buy, we must look for areas where we can get wholesale price. What we mean by that is, more often than not, retail investors get attracted to a script after the move starts happening or after the move has already happened. Friends, are you getting the catch point of retailers buying behavior on a chart? Can you get that point? Yeah. So who concentrates more to buy at wholesale prices? It's the institutions, because they are well informed. And prices are stuck in that range of consolidation mostly, right? But retail investors, their mindset is a bit different. By the very nature of them, they are generally attracted to buying a script after it starts making the move. All the move has already happened. So they want the prices to be in mobility, raising value, okay, or breakout, all that sort, so that they can participate in it, to see the motion, prices in motion, to catch their eye, right? And now do you get the meaning of why institutions also make purchases at different price points? We discussed in A&D session. So to catch the eye, they have to keep the price in motion, right? So that's why those buying at the middle of the curve takes place by the institutions, is initiated by the institutions. Can you get that, friends? This price has to be in motion, right? To move from a buying point to a selling point, which is high on the curve, for them to sell it at a higher price, right? But the very behavior of retail investors is such that their eye gets caught to price only when the move starts happening or move has already happened. That makes them very gullible to it, right? So we see people saying statements like, markets are booming or a particular script is booming, let's buy now, right? How many of you have done this or heard of it in the market? After the script has moved a lot, right? Almost to the high of the curve, people say, let's go and buy it, right? So nothing wrong with the idea, but the prices by this time has already traveled far from the wholesale price range. And now after the rally, you will be buying at retail price range. So what it means is, So nothing wrong in in buying some price, right? Buying a script at a high range. But you should be aware that price has already moved from a wholesale price range and it is in a retail price range, which is otherwise called expensive. So if you have such kind of understanding, right, what would you do? When you buy, if you're buying at a wholesale price range, what would your expectation be about that script? You'd be having very high expectations that the price can give you huge profits, right? And that also comes with a lot of patience of investing, right? And you can expect a huge move from that area because you bought it at a very wholesale area, right? But tell me, if you have bought it at a retail price range after the price has happened, after the move has happened, rally has happened. So if you have the knowledge, friends, what would you expect? What kind of expectation would you have on that price move further on? No, I'm talking about buying after a rally, Gopakumar. Buying after a rally. Yeah, the price should fall down. So thing is, if you have bought it at a very low of the curve, right, at a wholesale price range, you would have a huge expectation that price is going to move very, very high, right, to the high area of the chart, isn't it, to distribution. If you bought the accumulation area, right? If you are buying somewhere close to the distribution area, where the price already rallied, would you still have very huge expectations, having the understanding of whatever you have learned so far in this course? No, right? No. So your expectations with this knowledge would be that price can move up only up to a certain limited area, right? So does that give you an advantage to know what is the retail price and wholesale price, though you are buying it after rally? Isn't it, friends? Does it make sense? Yes. So that's the point, you should underline and see this is something which comes with the knowledge. The application part comes with your knowledge. So you knowledge, the whichever you get, you should look to how to apply it so that you build your expectations in according to that. Great, friends. So similarly, ideal place for shorting a script must be at retail price range where the price is expensive. Right, friends? Are you all clear with this? Super. So let's look at the psychology of retail price versus wholesale price. Institutions have a few very powerful weapons with them. One is, owing to their large position size, they have ability to move prices or even trick retail players. And thus, they can easily play with retail traders' emotions of fear and greed. In fact, they are such experts that they have almost tamed the retail traders to their plan. Like, they can make retail traders dance to their tunes. Right? It's a famous saying in English, right? So that's how well institutions have studied the emotions and buying selling behaviors of retail traders. Right, friends? So that's something which makes them very, very peculiar, right? Even with respect to forming price structures on chart and and tricking them, etc., etc. Right? So retailers have a certain characteristics to them with their buying and selling patterns. Similarly, institutions have have certain structural way how they do the buying and selling patterns, right? And when you consider both, you want to lean onto the side of institutions because they are the ones who actually print price on the chart, right, friends? To very summarize that. Institutions intentionally create the scene of euphoria while taking prices to a supply or distribution zone. Right? Supply is nothing but an area where selling happens. Right? That's otherwise called a distribution zone. They know that they might not get enough buyers at supply zone where their true pending orders are to sell. Right? So they create dummy positive moves to attract retail investors to buying. So friends, are you getting the point that why you get some rallies in a distribution zone where the real interest is to sell by the institutions? It's a trick, right? It's a trick because they know only by doing so in a distribution area, right, they can make the retailers to be fooled to come and buy, put their buy orders there. Right, friends? Great. So feeling of greed takes over in such cases and retailers start buying at retail prices and eventually get trapped, since at these areas institutions are actually filling their sell orders gradually to novice uninformed retail traders. And as and when price reaches the supply zone or distribution area and their last sell orders gets filled, there will be a sudden and significant drop in prices. Right? This is what happened at distribution areas, right? In our A&D session. You have done a homework, right? This is what you would have seen mostly on the charts. Right, friends? So once the gradual process of distribution is complete, price starts falling, right? When it falls, what happens? The retailers are stuck there, right? They are stuck in their positions at the high of the curve. So many traders will get trapped here due to emotion of greed, and that is how exactly institutions catch novices. Right, friends? Have you got the psychology behind retail price versus wholesale price on the chart? How they would want to drive it? Yes. Similarly, at an accumulation area, right? What kind of dummy moves would be created? The dummy moves are sell moves, right? In the distribution area, dummy moves are positive moves, right? To attract retailers. In accumulation area, friends, what can be the dummy move? Sell, right? So dummy move would be on the negative side at the distribution, at the accumulation area, so that retailers will come and sell, right? Thinking that the price is going down. And that's exactly how institutions catch the retailers' orders at the accumulation area, so that they can buy when the retailers are selling. So that's the psychology that goes on in the market. The institutional order placement and price action. Owing to institutional big orders, they do not get complete order fills in one go, and so they fill orders in parts. Right, friends? They have a huge order in place, but generally they don't get complete order fills in one go, and that is why price has to spend some time, right, in their range, and especially reaching those those areas of their bands, right, again and again, so that their orders can get filled. So it doesn't happen in one go, right? That's what it means. So which in other words means that price visits these institutional big order areas, right, multiple times to give them fills. Right, friends? Are you getting the point? So it doesn't happen once, right? That means if it has to happen, price has to come there multiple times. Isn't it? So that's the catch point for us. A small hint, right? The price range where their actual orders are present is said to be the area of interest for us when price reaches there in future. Right? So we are here to participate along with them. So if we want to know their behavior, where they are buying, where they are selling, right, we need to concentrate on the area of interest which they are forming at their actual order placement areas, so that when price visits those areas in future, we can also participate with them, right? We can notice that and participate with them. Initially, part of orders get executed in AOI, but it also creates significant movement which retail traders notice and try to take advantage of it. Right? When they get a first fill, price moves. When they get a second fill, price moves. So retail traders now get little intelligent, right? Like us. Now they want to identify the AOI area so that they can now try to take advantage of it. How? They want to buy along with institutions at that area, right? At that area of interest. This is the reason institutions have to play tricks to prevent the retail traders from tagging along with their orders. Right, friends? So if too many retailers are getting in, identifying the areas and buying along with them, right? So they may not get sufficient fill, right? So this is one of the reasons they also have to play the tricks. So you might have seen you may have like 2-3 buying areas, right, on a chart. And some areas are working, some areas are not working, right? So it could be that there is a trick that is getting played, isn't it? So at one area they are not getting the fills because everybody else is buying at that area. So ultimately move the price to another area, stopping them out so that they can get the stopped out orders as well as fill in the new area, right? That's also a trick, isn't it, friends? Friends, are you with me? Great. So after a part of order is executed by institutions, they use various tricks and bring the prices back to their area of interest in such a confusing way that most retail traders are not able to gauge the actual intention or direction. This again is about the trick, right? So price is coming to an area, going up, and then again price is again turning back to an area. Now what does that make it, right? That makes the retail traders totally confused. Price is moving up and price is moving down. So what's happening, right? Sometimes the retail traders may also be buying it after a move, right? And again price is turning back below their price. So what happens? They're just thrown out, isn't it? And when they are selling it, right, it becomes a buying for institutions, giving them fill again. That's how they confuse the retail traders. Especially as long as they're not getting their fill in their area of interest. So our area of interest is the price range where we know that institutional orders are pending. If we can learn their ways, it works to our advantage to participate along, friends. So that is what the point that we are getting into, right? So that to get to this point, right? To get to this point called area of interest, right? We had to cover this much of theory, friends. So are you all getting where we are going with all these slides, friends? Right. Okay. The next concept that we're going to look at with respect to institutions is the order flow and stacked orders. All right. There are two types of orders: market orders and limit orders. How many of you are aware of market orders and limit orders, friends? Hemant says me, great. Anshul, yes. Pradeep Sharma, yes. Okay, great. Let's see what it is. All right. Market orders are placed to buy or sell at the current market price, otherwise called CMP. Okay. Higher quantity than available will result in price move in the direction of the order, right? Until order quantity is filled or consumed. So what it means is, friends, let me take a pen, right? Market order is something, friends, which we place to buy a certain script, okay, buy or sell. Let's take the case of buy for the moment at current market price, okay. Now, let's say you want to buy a 500 quantity of certain stock. Let's say CMP, okay, is say 100, okay. At 100, some sellers are available, okay, for 100 quantity, okay. 100 quantity is available at 100 rupees in the market right now, okay. There is another 101 rupee, right? You have another 100 quantity available. Let's say 103 rupees, you have some 200 quantity of sellers available in the market. At 105, you have let's say 200 people, okay, 200 people, 200 quantity is available in the market as sellers, right? This is sellers. Now you want to buy 100 quantity at current market price, right, friends? So you want to buy it immediately right now and just buy it off, okay, at current market price. Whatever whatever price it is available, you want to buy 500 quantity at current market price, okay. Let's say you are thinking that price is going to go to 120, okay. Then you may want to buy it very quickly, right? And you may want to buy it at whatever price is available less than 120, right? So even if you buy it at, say, even 110, right, average price of 110, when you sell it at 120, you can make 10 rupees profit, isn't it? Make sense, friends? And that is where market order comes into play. So how you just do it? You want to just buy whatever is available, okay, at the current market price, and you place this 500 quantity and just push the buy button. What happens? It's a market order, and it is going to buy the quantity of whatever price available in the market to fill this order for 500 quantity. So what happens next, friends? See here, the quantity is what matters in this market order. Get this, okay? Quantity is what matters to fill a market order. because market order is put to fill the quantity at whatever current market price is. Okay? So when you place this, first 100 quantity is filled, so balance they have 400 quantity pending. Immediately this second 100 quantity is also bought from the seller. This 200 is also bought from the seller. So that makes a fill of how much? 400 quantity, and 100 quantity from this 200 is also gets executed, gets bought from the seller. So what happens to the pending order here? Pending order is now 0, right? Right, friends? So this order is filled. Okay, now this order is filled. So whoever placed this market order has got their fill. Okay, now let's see the second aspect of it. When he got the fill, right, at the current market price as a market order, what happened to price? So when filling the first 100 quantity, right, let's say price was now at 99 rupees, okay, on the chart. When he bought this, when he got the fill of this first 100 quantity, he is buying at 100. What happened to price? It went to 100. No, Hemant, I'm saying it was 99, okay? 99. Next seller is available for 100 rupees. This is where it starts, okay? Now what happens? Price, by giving the fill of first 100, shoots up to 100, right? Then while giving the second fill of 100, it goes to 101. Right? While giving the fill of next 200 quantity, it shoots up to 103, right? And while giving the last fill of 100 quantity, what happens to price? Price now shoots up to 105. Okay? Now how price is shown on the chart, right? When you execute this in an instant. Price is going to, system is going to execute this in a one go, right? Immediately. And what happens to price? Price just shoots up from 99 to 109. Yes, Sukesh, it all happens immediately. Right? So this is what happened. So what happened here? Price immediately shot up, right, from 99 to 105. By that way, this order got filled, and now you need to calculate what is your average price, right? Right, friends? Are you with me? So average of all this becomes your buying price. So this is how a market order gets executed. Similarly, if somebody is selling at a market price, right? Now the price is 106. 106. Somebody is selling at a market price, say 600 quantity. What happens? 200, 200, 100, 100, 600. If they're selling with a market order, price just falls down to this 100, right? Forming a red candle, isn't it, friends? That's the dynamic of market order. Friends, are you all very clear with this? Market order. This is something we should know. That's why I'm taking some time to tell you this, right? Yeah. So second is limit orders. Limit orders are placed to buy or sell at a predetermined price. Okay. Now get the very clear distinction. Okay. Current market price and buy or sell at a predetermined price which is yet to come. Okay. So higher than available quantity, what will happen to price? Will not give order fill till price arrives there again. So let's say you have a predetermined price, let's say 100, okay? let's say 100. This is where you are placing, let's say 10,000 quantity. All right. So limit order says if you want to buy it at a particular price, right, you place a limit order. And let's say a first time price came here. Okay. There were 500 sellers available at 100. So what happened? 500 quantity got filled here, right? Now let's say after this, some buyers came and took the price up. Now what happens to this fill, friends? What happens to the balance 9,500 order quantity? It is pending. Okay, great. So this order is not filled. 9,500 quantity is yet to be filled. When does that get filled? Okay, when does that get filled? It gets filled, okay, only when price arrives back to that area, and depending upon how much ever the sellers were available there, this starts getting executed or filled. Right? Are you clear with this, friends? So to get this order filled, price has to come again and again to this area, and sellers should be available so that this order gets filled. Right? Let me give you another type of order, right? There is also another type of order. You know that institutions also have this algo trading, and they also have a flush of release of orders also, right? They can also set a range of price, right? They have a range of price to buy, let's say 100 to 110 sale, okay? Now they want price to come to 100, okay? So they can release a market order. They can release a market order to buy at CMP, okay, between 100 to 110. Are you getting me? They want to place a limit order, okay, combined with a market order facility, which can get triggered once price hits 100. So let's say price hits 100, okay, this order get released to buy whatever is available between 100 to 110 quantity range. Do you see? Price, once it hits here, price shoots up, right? And then it's over. Fill is over. Now price goes to 111 or 110 point, say 10 paisa. Okay, price is not moving further. Somebody else may come and buy it and take it up. But again, when price again comes back here, price again shoots up, right? So just understand this, all right? This knowledge makes you understand a lot of things as we go by, right? That's why I'm giving this thing to you. So friends, have you understood market order and limit order clearly? Right. So stop loss pending orders are considered to be limit orders, friends. Right? So only when the price reaches that point, it is going to get triggered. Okay? So it's a limit order. All right. So how many of you have seen this table on your platforms? What is it called? It's called a market depth. All right? It's called a market depth window. On the left, you have buyer or bidders with the quantity, and in the middle you have price, and on the right you have sellers or ask orders who are offering their quantities at a certain price that is in the middle. Okay. Now this is nothing but an order flow window that is visible to you, at least, right? There may be some five on the right and 5 on the left may be visible to you all the time. Okay. Let's try to understand this. Okay. Order flow happens classically through market depth window of sell offers and buy bidders. There will be large undisclosed orders available in the system, which cannot be seen on this window. Friends, are you all aware of this? Undisclosed orders available in the system? So in other way, let me ask you, if let's say instead of this 100 quantity to be bought at 236.6, right? If you see 1 lakh quantity being shown on this window, what would you do? You are watching this window, right? And the moment you see 1 lakh units coming in this area of buyers, what would you do? You would immediately want to jump in and go ahead and buy it, right? Along with them. Isn't it, friends? So if you are going and buying there, right, what may happen? That 1 lakh may or may not get filled also, right? Right, friends? So in a way, what you are doing, you are not helping the buyer who is placing a huge order there, right, to get a full fill, right? Complete fill. So you may even go and buy, looking at his 1 lakh order, you may go and buy a 236.8. Somebody else may come and buy the 237 before this 1 lakh quantity gets filled. Isn't it, friends? Friends, are you with me? Yeah. So you may come and place 100 here, right? Somebody else will come and place 100 here. Somebody else may come and place 100 here. What happens to this 1 lakh? It is going to remain as it is, right? So no fill. The price is moving here. So when institutions are wanting to buy such huge volumes, they do not want to be shown here. That's why we have an option called undisclosed orders. Have you seen it in our order placement window? Right? They don't want the large orders to be visible to retailers. That's why you have this option. Okay? So in a way, this data that you see on this table, friends, is also deceiving. Okay? So you just get that point. It can be deceiving because there's also undisclosed orders which are not visible to your eye on the system. Okay? That's the point I want to make about undisclosed orders. So whoever want to buy huge orders, quantity, be it through market or be it through limit orders, right? Especially, they would not want the orders to be completely visible. Okay, they just do it using undisclosed orders. Second thing, friends, is something called spread, right? Which you need to know. Spread is nothing but the difference between price, okay, difference between the price between the buyer and the seller. Okay, in this case, 236.6, 236.8 is a seller. Okay, the spread becomes 20 paisa here between the buyer and seller. Okay, are you with me? So if price has to move up or down, right, up or down right now from CMP, either the seller has to sell at 20 paise less to this buyer at 236.6, or this buyer has to spend 20 paise more to buy from the seller. Okay, that's the difference, and that difference is called a spread. Okay, and if you see, friends, if the price has to move again, right, on the upside, the buyer has to spend, right, a difference of whatever is available between the buyer and seller. Okay, in this case, let's say this got executed. Okay, this buyer is at 236.5, this seller is at 237. Okay, now 50 paise difference, right? So on and so forth. Okay, so in simple, the difference between the price, right, between buy and sell, right, is called a spread. So you need to be very watchful when you deal with many scripts, right? Because in this window itself, you can see on the buying side, 236.5, 236, 236.4, and 235. There's a spread difference, right? Similarly, in sellers also, there is a spread difference. Here you have 1 rupee difference. Here you have 50 paisa difference. Here you have 20 paisa difference. Isn't it? So, you need to be watchful of this phenomenon called spread when you are dealing with scripts. Okay? Because what may happen is, sometimes you may place your stop loss, right, at a particular price. If the spread is like this on a for scripts, what could happen is your stop loss could get very easily triggered. Right, friends? How many of you have faced that trading certain scripts? Just in a jiffy, your stop loss is gone, right? That happens when you are dealing with scripts which have huge spread. Right? So, scripts with least spread and high average volumes are said to be liquid scripts, which shows high level of participation. Okay, now level of participation. Now, if there is a huge interest of market participation in this script, right? You may not have such kind of spreads between the buyers or the sellers in the script. Okay, so you need to watch out for trading in scripts which have less spread. Okay, less spread means there is high level of participation that also comes with the volumes being traded in those scripts, and you need to look at such scripts, and those are called liquid scripts. All right. So be watchful of that. Okay. And scripts with more spread and lower volumes are said to be illiquid scripts. So try to avoid such scripts so that when you do analysis with your hard work, you don't want your money to be taken out by market just like that because you chose a wrong script. All right, friends, have you got the understanding of this order flow? This is how order flow is executed for buying or selling in the market. Amazing. Shall we move on? So friends, before we move on, shall we take a 5-minute break? I have a lot more to cover. All right. Okay, it's 8:18 now. Let's be back by 8:23, friends. Next is stacked orders, friends. Just look at this window, right? Look at this picture. In any price chart, price, right? Price is printed on the chart, isn't it, friends? When buyer and seller price meets, when their volume and price meets, right? An order gets executed, isn't it? So does that mean an order got filled? And when an order gets filled, right, price is printed on the chart, isn't it, friends? Let it be a line chart, let it be a candlestick chart, let it be any type of chart, right? A price chart. What you see on the chart is something is printed on the chart, right? Some price is printed on the chart. How it gets printed is when a buyer and seller's order get fulfilled, right? So a transaction takes place and that gets printed on the chart. So in other words, whatever price you see on the chart, right? Whatever price, look at this curve, right? Price has moved up, down, up, down, up, down, right? So on and so forth, and has moved up again, right? So what happened here? Price got printed on the chart, isn't it? Yeah, price reflects filled orders on a chart. That's the first point. Empty space surrounding it is full of unfilled orders. Can we say that, friends? So the unfilled space on the chart, right? If what is printed on the chart is nothing but filled orders, right? What does that empty space surrounding it mean? So can we say that empty space is nothing but unfilled orders? Is it, friends? Isn't it? Yes. So that brings us to the concept of stacked orders. Okay. Unfilled orders is what move market price up or down, isn't it, friends? It depends on the unfilled order. It could be a buy order or a sell order to take price up or down, right? That is going to determine how the price is going to be printed on the chart, right? On the blank space, right? Next candle gets formed, okay, depending upon the type of order that gets filled, isn't it? Somebody is buying at a higher price, or somebody is buying at a low, selling at a lower price, isn't it, friends? Can you get that? That's the hypothesis, the logic. Friends, yes or no? Are you able to get that? Super. So we need to focus on big unfilled orders, right? On this chart, friends, on this chart, this is how order stacking happens in a chart. Okay, as price is moving up, right, moving up the ladder in a price chart, okay, more and more sell orders of the sell type, right, or more selling orders are stacked as price is moving up and up. Okay. Similarly, when the price is moving down the chart, more of buy type, right, more of buying orders are stacked on a chart. Can you get that? So can you see the lot of red people, right? Lot of red sellers, right? They are stacked more on the upper side of the price than on the lower side of the price. Right, friends? Similarly, more of the buyers or buy orders are stacked on the lower side of the price, right? And they reduce as price goes up. Okay, this is how orders are stacked in the market with respect to price. Friends, are you clear with this? So here buyers, that is nothing but blue, are stacked more from lower prices, and sellers, which are shown as red people, right, are stacked down from higher prices. So if you have to take advantage of the stacked orders in the market, you should follow the principle of buying low and selling high. Friends, does that make sense? Because if more of buying is going to be at the lower side of the chart, then you should be a buyer than a seller, because you are not having a strength of being a seller when the price is very low, right? And when price is very high, right, being a buyer doesn't give you strength to move price further up. You have to be a seller there because you have to be participating with the market. Friends, is this interesting? Is this slide interesting for you? Does this deliver something valuable, right? Okay. So let's look at the example of an institutional buy, which we have already discussed, right? It's just a pictorial representation. Now, institutions want to buy 50 lakh shares between 920 to 940. Okay? Range is 920 to 940. So what kind of orders do you think they will be putting in the system? Quickly, friends. Buy orders, excellent. Okay. Okay, limit orders. Okay, now the range is 920, 940, right? So it could be multiple limit orders, right? Or it could be a combination of both limit and market orders also, right? Because the range is 920, 940. Does it make sense? Yes. So price, when price visits this area, what happens? First they got a fill of 25 to 30 lakh shares out of 50 lakh budgeted volume, okay, at this price range. Then what happened? Price moved up. So how much of the quantity is still pending, unfilled? Half approximately. All right, right? So 25 to 30 lakh shares got filled. So they have roughly around 25 to 20 lakh shares pending, right? So when will they get filled? They get filled when price revisits that area, right? So our interest is to identify such areas, right, which are areas of interest for the institutions. So what we do? We identify such areas, right? We identify such areas. We look for that buy zone, okay? And when price revisits that area, right, giving the institutions a fill, we are looking to buy on the retest. Okay, so we are planning to buy along with the institutions. Okay, and then we want to enjoy the move that is happening, right, after we participate with them and enjoy the rally along with the institutions. All right, this is our complete motto, right? This is our complete motto of how we want to participate along with the institutions, right? So for that, right, we need to identify how the institutions are making the purchase, right, which is the area of interest of institutions, right, friends? So if you are able to identify that, then we can participate along with them when price visits that area next time. Okay, so that's the crux of of the subject, which takes us into the next part of today's discussion. Okay, so let's redefine what makes price move. Price moves in response to order flow and stacked orders. Order flow occurs when at a particular price level, someone believes that price is either cheap or expensive and decides to buy or sell correspondingly. So when somebody considers the price to be cheap, they're going to decide to buy. When someone believes the price is to be expensive, they decide to sell, right? That's how order flow is executed at a particular level, isn't it? However, if there is a sort of balance between buyers and sellers, price might consolidate in a range, creating an equilibrium. That's called balance. So let's say at an area, right, at say 910 to 920, where institutions want to buy in the previous example. Okay, 50 lakh shares they want to buy. Okay, and at that area, right, they're getting the entire fill there. Okay, and there is no more orders there to move the price up. What happens, friends? So at that 910 to 920, right, once price visits there, continuously there is buying and there is continuously selling happening. Okay, what happens then? When buyers are able to meet the sellers at a price point or a price range, what happens? Price is stuck in that range, right? Isn't it, friends? When buyers are meeting the sellers, right? Price is stuck in the range. It is not able to move further, right? That kind of range, friends, is called equilibrium, or in other words, called a balance between buyers and sellers. Okay, so what happens is price is stuck in that range, and it's also called as a consolidation, right? Like we have seen in accumulation or distribution, which is happening in a range, isn't it? But the fact is, prices won't be able to stay in equilibrium forever. Okay? There will be a continuous fight between the bulls, that is buyers, and bears, otherwise sellers, until the price breaks out in the direction of bulls or bears who has higher order flow in their favor at a particular price, okay, in that range. Thus, it breaks the state of equilibrium. Right, friends? Sukesh has a question: how is accumulation distribution different from consolidation? Sukesh, it's all the same, right? Consolidation, right? Accumulation happens in a range, isn't it? Before price is moving up, right? So when price is stuck in an accumulation area within a range, right? It is said to be under consolidation. Right, Sukesh? The range of accumulation on any price chart where price is stuck in that range, okay, or distribution range where price is stuck in that range, right, is nothing but a period of consolidation, because price is stuck in that range, it is not able to move either ways, right? Sukesh, did I answer your question? So only when price breaks out of accumulation or the consolidation area, right, we call that as a breakout. Or the price is on the move up, right? Which means buyers have overwhelmed the sellers at that area, isn't it? Similarly, in a distribution, right, there is more of sellers there, that is selling is happening there, and buying is also happening there to fill their orders, right? So once the buyers get exhausted, what happens? Sellers take over, right? And thus price drops from that consolidation area of distribution. That gives a breakout at the distribution area. Sukesh, did you get the answer? What consolidation means? Consolidation is nothing but, a sideways stuck of the price within two ranges. That's otherwise called as equilibrium. Okay, but prices cannot stay in equilibrium forever, because bulls and bears are going to continuously fight, and whoever has a stronger order flow, right, they will be able to break that equilibrium and move the price in their direction. So Hemant has a question: after price move any one side, we define accumulation or distribution. Yes, yes, Hemant. Okay, Sukesh says consolidation is balance between buyers and sellers, but accumulation distribution is institutional activity with a view of direction, right? Actually, Sukesh, they are the same, Sukesh. They are the same, right? Let me take a pen for you. See what happened in accumulation? Price was moving up, down, right? Is this a range? And what was happening here? Maximum? It was buying, right? Buying is the bigger activity that is happening here, right? So sellers were filling in their orders. Okay, there is a huge buying order here. Now, as long price is stuck in this range for how long? Until the maximum orders are filled here, right? Yeah. Now, when maximum orders are filled in, what happens? price breaks out, isn't it? Now when buying is overwhelming selling, or no, sellers are depleted here. Okay, sellers are depleted here. Buyers are overwhelming sellers, and thus price moves away from that area. Okay, when price moves away from this area, it is called a accumulation area, right? Because price broke out on the upside. Let's say at the similar consolidation area, this is called a consolidation, right? There is a constant tiff between the buyers and sellers. Okay, now price is in a range. Okay, it may be for weekly, it may be for monthly, it can happen for days, hours, or even sometimes even minutes also, depending upon the time frame you look at. Okay, now let's say sellers are taking over the buyers. Buyers have lost interest. Okay, they're not able to buy anymore, and sellers are powerful here. Price drops. What does this has this consolidation led to? To an accumulation or to distribution? Sukesh, please answer me quickly, please. This makes a distribution, right? Because price was stuck in this range, in equilibrium, consolidating in this range, and then price broke out on the downside. Okay, clearly bears were in power here. In this case, bulls were in power. So price broke the equilibrium state or consolidation state, and price moved up. Okay, so this is what happens. Like price cannot be stuck in equilibrium state forever. Okay, forever may mean, depending upon the time frame chart you look at, it can be, it can be for hours, it can be for days, it can be for weeks, months, etc., etc. Okay, that's how it is. Are you clear, Sukesh? Hemant has a question: how to guess prior to any time? I am not getting a question. How to guess prior that any consolidation become accumulation distribution? Hemant, that is why you need to actually wait for the breakout on the upside or downside. That's why it is called as indecision, friends. That is why it is called as indecision or consolidation or equilibrium. You never know what's happening here exactly, right? Unless price broke out. Right, friends? Are you clear with this? So never look to guess something, that is happening in this kind of phases. Wait for clear breakout and then retest. Breakout and then retest to make a clear decision about it. So this action of price and order filling creates zones. Okay, and these zones symbolize the potential of the expected order flow. Right? So if price broke on the upside, right, it has created a consolidation zone there, right? An equilibrium zone, and then price broke out on the upside, right? And it clearly states that buyers were in control. So when price comes back to that zone, right? Comes back to that zone, what is the order flow do you expect? We just saw it in the Reliance example just before, right? Between 910 to 920, you had a zone, right? And price, when it visited there, what kind of order flow are you expecting? Because price broke on the upside, right? From 920. What is the kind of order flow you expect, friends? Buy or sell when price visits that area? Buy, right? Exactly. Similarly, if price has broken down from that area, right? When price revisits that place, that zone, what kind of order flow would you expect? Sell, right? Exactly, that's the logic. Okay, so what we mean here is price cannot stay in equilibrium forever, and it will break out on upside or downside depending upon who are in control, buyers or sellers. And when that happens, right, when that happens, price creates zones on the charts. Okay, and these zones symbolize the potential of the expected order flow in the future when price visits that area. Okay, so order flow trading is all about predicting the future order flow that will be generated to move the market when price revisits those areas. Right, friends? Are you all clear with this? Now we have come to a place where we are clearly seeing that price leaves zones, right, after consolidation. It could be a buy or a sell zone, right? Now, friends, that brings us to the subject of today called demand and supply zones. Right? So are you all clear with whatever we have dealt with in today's session so far, friends? Does that give you a holistic perspective of why we are coming into this subject heading called demand and supply? Yeah. Because price leaves something on the chart which is a institutional activity for various reasons, right? We saw all those processes so far. Since our focus is with institutions, we will henceforth follow the language of them. The term demand is an activity associated with the institutional buying. Okay? And the term supply is the activity associated with the institutional selling. So henceforth, we'll be calling an institutional buying activity as a demand, an area, right, as a demand, and an institutional selling activity area of interest as a supply. Are you okay with that, friends? Are you clear? This is what we're going to use henceforth. Okay, Gopakumar, you can go to the recording. Yeah. As the demand for a particular commodity, or in our case scrip, increases, there can be two cases happening at supply end, right? At the selling end. The supply is able to meet the increase in demand, right? So buyers and sellers, right? Supply means selling, demand means buying, right? If supply is able to meet increase in demand, right, what happens to price? Price is in equilibrium, right? Price gets stuck in a range, equilibrium. And second case, if supply is not able to meet the increase in demand and there is spike in prices, creating an upward movement of prices causing a demand zone, which means the sellers are not able to meet the requirement of buyers, right? Then what happens? Price spikes up. When it spikes up, what happens, friends? It creates an upward thrust of price movement, isn't it? Breaking from the equilibrium, isn't it? So when the sellers are not able to meet the requirement of the buyers are more in control and they cause the price to shoot up. Okay, so when such thing happens, it gives rise to a demand zone on a chart or a buying zone on a chart. Okay, so when price visits that area again, what kind of order flow can we expect? Buying, right? We can expect that when price comes to the demand zone, we can expect an order flow of buying type. So we can place our buy orders and we can go along with the buyers. Similarly, as the supply for particular script increases, there can be two cases happening at demand end. Demand means buyers and friends. Okay, demand is able to meet the increase in supply, and that brings price into an equilibrium. That is, price is not going to move anywhere, right? If sellers are met with the buyers, their requirement is fulfilled by the buyers, price is not going to move. Similar as in the demand case, right? And when the buyers are not able to meet the increase in supply, or the sellers, and there is sudden fall in prices, okay, creating a downward movement. So if buyers are not able to sustain the sellers pressure, right, price is going to fall down, right? And that will create a downward movement, and that creates a supply zone on a chart. Friends, are you able to visualize how a supply zone gets formed? After equilibrium, price drops, right? That causes a supply zone. Okay, friends, are you all clear with this so far? Excellent. So, demand and supply zones are basically decision points on a chart. Okay, so at some particular price, at particular price point or price range, a decision is being made that price is going to turn, right, on the up or down, because buyers or sellers, they were powerful in that area. Accordingly, if buyers were powerful, then it creates a demand zone. If sellers were powerful, it creates a supply zone. So in a way, a decision is being made at that area, isn't it? So when price revisits that area, it follows that decision, right? These decision points are in turn the storehouse of order flow. And that is how when price gets back to that area, we use the storehouse of order flow to rely on our buy or sell at the decision point. Okay? Since it takes a lot of orders to break out of consolidation zone and to create a substantial movement in price, so there is a very high probability that these areas will still have orders left at the zone and are tradable on retest. Okay? Now hope you got the point, like, why we want to trade on retest. First is we want to first be very clear that what kind of structure is price, what kind of decision is price making at a consolidation area, right? And then we want to be sure of that to participate on the retest, because those areas where decisions are made are nothing but storehouse of order flow for the future. Friends, are you all clear with this so far? Okay. Now let's look at chart elements for supply and demand, right? So broad categories of candles. There are two categories. One is momentum candles, okay, and second is consolidation candles. I hope in the previous session of candlesticks basics, we have come across these types in detail, right? Right, friends? Is it not? Do you remember? So we're going to use the basis of the previous session, right, to enhance today's session. Okay. So broad categories of candles that we're going to use to define our demand and supply zones are momentum candles and consolidation candles. Okay. So just to refresh you, these are the examples of momentum candles. So momentum candles are those where you have significant body, the real body, within the range of an entire candle, right? Where there is a very clear sense of direction of price movement. All right. And you have the other set of candles called consolidation candles, or we can also call them as equilibrium candles or base candles, otherwise called indecision candles. So they can be called by different terms, right? But they all mean the same, right? So equilibrium we have dealt with, consolidation I have explained, right? Base is something is nothing but consolidation, is otherwise called as base. Indecision is also something where a larger overwhelming of buyer or seller is not happening in that candle. Okay, and those candles look like this on a chart. Okay, where the body, the real body, is significantly lesser than the entire range of the candle. All right, friends. In this case, it is 55% or lesser of the entire range, the body size. Friends, are you all clear with this so far? Okay. See, we are also attaching, what's behind these candles, right? That's very important for our understanding. Whether momentum candles or, the equilibrium or base candles. You should know what's there in that candle, right? Just by hearting them as whatever it is doesn't help us any longer. Okay, that's why we're spending so much time on these the basics of it. Okay. Next is elements of price action. When price makes a significant bullish momentum candle or series of candles creating an upward thrust in price, it is said to have created a rally. Okay, so what it means is the first element, right? Let's say a bullish momentum, right? It's called a bullish momentum. So how does a bullish momentum happen? Bullish momentum happens like this. This is a green candle, okay? Or it can also happen with series of momentum candles, right? The direction of the movement of price is up in this case, friends. So upward thrust in price is what you see in this structure, okay? And this element, okay, this element of bullish momentum candle or series of candles which is creating an upward thrust of price, right, is called a rally, friends. Okay, so you need to remember this, that when price is creating an upward thrust and creating a series of momentum candles, it will be called a rally henceforth. Okay, so the next element is when price makes a significant bearish momentum candle or series of candles creating a downward thrust, right, it is called a drop. So, and how does this candle, how does this drop represent by price? One is you have a momentum red candle, right? Momentum red candle leading to a downward thrust of price, okay, from up to down, okay. This is a drop. Or you can have series of momentum bearish candles leading to a downward thrust of prices. This entire structure can also be called as a drop. Friends, are you with me? Have you got this? Rally and drop, two elements. Okay, let's go to the next element. When price does not make any significant move but is staying within a range of price, either by a single or multiple candles, it is said to be consolidating or in equilibrium in the or basing in the range. So what it means is we have seen the consolidation candles, right? We have seen several consolidation candles, right? It could be any of these, right? It could be one candle or it can be multiple candles. Okay. Now what's happening here is price is stuck in the range. Okay. It is not moving up or down, right? It's not moving up or down. It is stuck in a range. Whether you take the candle individually like this, okay, like this, or you take it, with a multiplicity like series of candles too. Okay, you will see that price is stuck in a range, and it is not signifying any strong pressure of buying or selling in that candle. That is why you have the real body, okay, less than equal to 55% of the range. Okay, this kind of candle, okay, is one of the element of the demand supply structure, and it is called a consolidation candle, or a equilibrium candle, or a base, right? In this case, you have a single base or a consolidation candle. In this case, you have 3 bases or consolidation candles. Friends, are you with me? Are you clear with those 3 elements of price action? Rally, base, and rally, drop, and consolidation or base. Excellent. So what we do is we use these elements along combine these elements, and we get the price structures, okay, on the chart. And price action trader is somebody who uses these price structures, right, along with the price movements, okay, to trade. Okay, so it's a methodology that is involved in trading using this price structures. That's called price action trading. So what are price structures? As price moves, like as orders are getting filled, price creates certain structures on the chart. So we have broadly classified the price structures as, so friends, we have 3 elements, right? Rally, drop, and base. So you can combine these, right, and form some price structures. Okay, so we have basically four classifications broadly. They are rally base rally, drop base drop, rally base drop, and drop base rally. These are the 4 price structures that price forms on a chart. Okay, are you clear with this, friends? So what we have, we need to define the zone, right? Demand or supply zone. For that, we'll be using 3 elements henceforth. Okay, they are moving, which is represented by a momentum candle, right? It could be a rally or a drop. Okay, and second element is consolidation candles. Okay, and consolidation candles are represented by dojis, bases, or equilibrium candles. Okay, so these are the elements, 2 elements, and there is a third element called move out. Okay, move out is also a momentum candle. Okay, or there can be multiple momentum candles, right? So that these are the 3 elements which we use to define a demand or a supply zone. Okay, so there is an element called having gaps, right? Gaps, which we will be dealing with in the further sessions. Okay, so there are also demand or supply zones having gaps in them. Okay, they are also considered to be important. Okay, along with and these gaps should be associated with move out candles. Okay, so 3 elements for a zone: move in, consolidation candles, and move out. Friends, are you clear with these 3 elements? You require 2 momentum candle structure and a consolidation candle structure. So this is an example where you have a drop in price. Okay, you have a drop in price. It's a momentum candle. It's called a move in candle. Okay, this is a consolidation candle or a base candle, which is the second element, okay, of the demand. And this momentum candle is a rally, which is called a move out candle. Okay, so to define a demand zone, you require a move in, which is a momentum candle, consolidation candle, and a move out candle. Friends, are you clear? 3 elements. Yes, exactly. Similarly, for a supply zone, you require 3 elements: a move in candle, in this case it is a rally; a consolidation candle, it can be a single candle or multiple candles too, right? Base candles. I've just told that in the previous slide. And the third element is move out candle. Okay, and here in this case you have 1, 2, and 3 move outs here. All right. So it's a rally, base, and drop. Right? This entire structure is also a drop. This three candles is also a set of rally, base, drop. All right. So basically, to define a demand or supply, you require 3 elements, which is move in, consolidation, and move out. Right, friends? Are you clear with this? Okay. So here, friends, in this example, this structure, let's just, what is this, friends? What is this? Series of momentum candles, move in, yeah, or otherwise drop, right? And what do you have here? So you have a move in, then you have a base. Then what do you have here? What is this candle? It's a momentum candle. In this case, this element of demand is called a move out. Okay, this is a rally. So you have a drop base rally in place, and this is in this case, after this consolidation, right, sideways range, otherwise sideways range, what happened? Price broke out on the upside. So it's a demand zone. Okay. Similarly, example here, you have a move in, which is a rally. You have 2 base candles here, and then followed by a rally in price. Okay, you have 2 momentum candles here as a rally. So this structure, okay, this rally is a move in candle, this is a base candle, and this rally is nothing but a move out. Okay, this is also a demand. This is a drop base rally demand, this is a rally base rally demand. Right, friends? Are you all clear with this part? Great. Now on the right, what is this element, friends? What is this element? It's a momentum candle. Yeah, it's a rally, and it's a move-in candle, right? And what do I have here? This is a base. Excellent. And what is this candle, friends? What is this element? It's a drop. Also, how can we call it? It's a move out. Okay. So 3 elements: move in, base, and move out. Rally, base, and drop. Okay, and this is a supply zone. Okay, similarly, because supply zone, because sellers took over here, right? Sellers took over here. That is why it's a supply zone. And what is this structure, friends? This is, and when you take this structure, right? This red candle, this basis, and this red candle, right? In the previous case, this was a move in, base, and a move out, right? And now when you look at these three set, what does this become? What is this candle? Okay, drop, base, drop, excellent. Okay, what is this element? What is this element? This momentum candle, right? What can we call it? It's a move in, excellent. It's a move in. And what do you have here? Two base candles, two consolidation candles. It's a base, right? And then you have a momentum candle. This is a red candle, otherwise called as move out, excellent. And it is also a drop, right? So what does this make this entire structure? Drop, base, drop. And what is this drop, base, drop? What has this caused as a price action here? Has it taken prices up or prices down? Down, yes. So it is a supply. Okay. So we have seen drop base rally, rally base rally, right? And elements of it called move in, base, and move out. Move in, base, move out. Similarly, in case of supplies, you have rally base drop and drop base drop, right? Elements of it is move in, base, move out. In this case of rally base drop, and in this case of drop base drop, you have a move in, base, and a drop. Right? Three elements to define a demand or supply zone. Are we all clear with this, friends? Shall we move on? Excellent. Okay. Price structures, right? So we have just defined the elements up to demand and supply. Okay. Now further going into price structures have two classifications majorly. Okay. They are reversal structures and continuation structures. Okay. Reversal structures and continuation structures. Okay. So we have seen what creates a demand, who creates a demand, right? Then how demand or supply are created, what is the intention behind it, who is gullible, who is stronger, okay? And then how your supply or demand zones get created on a chart, and what is the order flow expected when price arrives at those demand or supply in future, right? Buy or sell type, okay? And then we saw how to define a demand or supply elements, okay, with respect to elements so far, right? Now we're going one step further, okay, and putting all of these into price structures, which you're actually going to see on the charts, and you're going to give them some more meaning to them, okay? So from that perspective, price structures are classified into two major things. One is reversal structures, second is continuation structures. All right. Let's first look at what are reversal structures. Reversal structures are formed when prices are moving in a particular direction and pause, okay, for a moment and change the price direction. Okay. I'll show you an example also here. Okay. Now what it is price is moving in a particular direction, up, okay, let's say up, okay, and then it is actually moving from down to up, means it is moving from a cheaper price area to a expensive price area, right? Moving from down to up, okay, it's moving up right now. Then what happens? Price moves up, okay, it is cheap, here it is. It's not so cheaper, okay, it's not so cheaper, okay, it's moving to a higher area. Now it takes a pause, or it takes a consolidation, basically decision making process here, okay, and then it reverses its price direction. Okay, price moved up, it consolidated, and then it reversed its direction. Right, friends? Can you see the reverse of direction? That's very important after the pause. Okay, when this happens, it means that price has formed a reversal structure. Okay, because direction has changed. Yeah, Hemant says creating supply zone. Exactly, right? That makes it a supply zone. Can you tell me by price, by the drop, base, rally, by those elements, right? How will you define this? It's a rally, right? Base and drop. Excellent, Hemant. All right, friends, are you all with me? How this decision making is happening here in this reversal structure? Similarly, let's say price is moving from a higher price, okay, to a lower price, okay, up to down, okay. That means from expensive area, it is moving to a cheaper area. Direction is downward. Then price takes a pause, okay, and then decides to reverse its direction. Okay, in this case, it decides that price is cheap here, so price wanted to move to an expensive area again. All right. So what happened here? Price dropped, then it consolidated, made a decision, okay, forming a base, and then it decided that price is cheap, so it has started moving. Buyers came in and took it up. So price started moving to expensive area, right? So what is this direction, friends? Isn't this a reversal of direction? Price came down, and then after pausing, it reversed to the upward direction. Okay, it's a reversal, right? So this makes it a drop, base structure, and a rally. Important part here is, friends, the direction of price. Okay, that's the most important aspect with respect to reversal structures. Okay, friends, are you all with me? Have you got this point clearly? Why we call them as reversal structures? All right, let's go to the slide. So, in reversal structures, there are two types. One is a drop-based rally. It looks like this. Here, price was moving down initially, forming a drop. Then price paused and consolidated for a while, right, creating base or bases, and then price changed the direction and started moving in the opposite direction, which is up. Okay, otherwise we call it as a rally. All right, so the structure becomes drop-based rally. This is one of the reversal structures. And the second structure, friends, is rally-based drop. And what happens in rally-based drop? It looks like this. Okay, rally, base, and drop. Here, price was moving up initially, creating a rally. Then price paused and consolidated for a while, creating a single base or multiple bases. Okay, and then what happened? Decision was made there that price is expensive and price started going down. Okay, and that changed the direction of price and started moving in the opposite direction, which is down. Thus it creates a drop, right? So we have two structures, drop based rally and rally based drop, and here price completely reversed its previous direction, and thus they are reversal structures. Basically these are decision points, as it was decided to take price distinctly up or down from that point of price. All right. Also friends, in the past, price was decided to be expensive or cheap at these areas and caused a turn of price from its previous direction, causing a market force. So this is something which is very, very important. Okay. So when you see these structures on a chart, right, historically, it means that previously market forces decided, right, that price is cheap in this drop based rally kind of area structure. Okay, thus it created a reversal of price. Okay, and in the case of rally based drop, historically when price visits those areas, it was decided in the past that it was expensive, and so market forces had decided to reject the price from that area. This is what you can read on the chart from the structures. Have you understood the reversal structures, the in and out of it? Any doubts? Can I move on? Great. Okay, I hope this doesn't require much of explanation. You can clearly make out this is a drop in prices. Then you have base. Here it is a multiple base candles followed by a huge rally, okay, which is also multiple momentum candles. Okay, what kind of structure is this? This is one of the reversal structures called drop base rally. Okay, price was decided that it was cheap there, and price turned this direction entirely on the upside. Similarly, in the second example, prices were rallying up, then at a point, right, price consolidated, forming a base, and then it was found to be expensive there, and price got rejected from that area, creating a huge drop in price. Okay, forming a rally based drop. This is also a reversal structure, and in this case it is a supply. All right, friends, are you all clear with this? Okay. The second classification, friends, is called continuation structures. Continuation structures are formed when prices moving in a particular direction then take a pause, okay, that is consolidate. Then again, they decide to move in the same direction, right, how it came in the previously. Okay, so previously the prices were moving up, okay, and then at a particular price point, price took a pause, okay, consolidation or basing, okay, then made a decision whether the price is expensive or cheap. Then after the decision making process, it was decided that price is no more, right, no more expensive. Okay, price moved up, then consolidation. At this point, price was decided that it is no more expensive. Then what happened? Price started moving up. Okay. In this case, direction is the same as before. Here it was moving up, and after the decision making, it started moving up again. All right. So what kind of a structure is this? It's a continuation structure because price moved in the same direction, here in this case up. Okay. So this is a rally, base, and a rally. Okay. This is a move in, base, and a move out. Right. So you understood why we call it as a continuation structure? Basically to do the direction of price. Okay. Similarly, right, price is moving down. Then at a price point, price consolidated, making a decision making whether this price is expensive or cheap at this price point. Then what happened? Price decided the price is still expensive here. So price started moving down to a cheaper area, right? So what happened here? Look at the direction. The direction of the move out is the same as of the move in. So move in was downward and move out was also downward. Thus, the price continued the direction of the move in. Okay. So that's why this is also a continuation structure. Okay. Continuation structure. And what do we call this structure? This is a move in, we know, right? This is a move out. This is a base. And what is this structure, friends? This is drop, base, and drop, right? And this drop can have a single momentum candle or multiple momentum candles. Base can have a single or multiple base candles. And drop can also be a single or multiple momentum candles. Okay? Are we all very, very clear with all the elements and, in and out of all these structures? You should not have any doubt, with respect to this. Be very, very clear. So let's look at it. So first type of continuation structure is rally base rally. Here we have, this is an example. Here we have, first is a move in, right? Move in, which is a rally. Then a pause, which is nothing but a base. And then price continued moving up in the previous direction, causing a rally. So the continuation structure is rally base rally. Okay. Second structure of continuation is drop base drop, which looks like this. And what all do we have here? We have a move in, which is moving in the downward direction, creating a drop. And then price consolidates for a while, creating base candles. Then third element is also a drop because price continued moving in the previous direction, which was down. Okay. And thus, since price continued moving in the previous direction, it is called a continuation structure. Right, friends? So you have two structures of continuation, which are rally base rally and drop base drop. Friends, all you are clear with this? With the structure? Great. So you can see in this example, right? What is the structure, friends? What is the structure? Continuation structure called continuation structure, friends. I have marked two levels, right? Rally base rally, right? We have two rally base rallies here, right? This is a rally, base, and a rally, right? Similarly, here also you have a rally, base, and a rally, right? Here also you have a rally, base, and a rally. Right? Price, look at the direction. Price was continuously moving up, making these decisions. On the right hand side, right, you can see price moved down, consolidated, then it moved down. Right? So direction is down here, direction is down here, and you have basing here. So what is the structure? It's a continuation structure, and it is a drop, base, and drop. Right, friends? Are you all clear? Okay, now we'll go to the last part of it, where you have a combination of reversal and continuation patterns. Okay, so when you see reversal and continuation structures, price structures on a chart, right, they make a very strong statement on a chart. Always remember this. Okay, so what does reversal structure mean? It means a change of direction, major price direction, right? Change of price direction. So it's a major decision on a chart, isn't it, friends? Reversal structure is a major decision point on a chart, isn't it? And a continuation structure is also a major decision on a chart, isn't it? So just imagine if you had a combination of both at some price area of a chart. Won't you attach significance to that area? Because price is giving you two decisions at the same area, right? Right, friends? Can I get a yes or no? Yeah. So let's look at the combination of reversal patterns. Price is said to be forming a strong demand when a series of price structures are created, right? The series of drop-based rally and rally-based rally. So can you see, you have drop-based rally, which is also a demand, and a reversal structure, right? In combination to that, you are having rally-based rally, which is also a demand structure, right? Forming together with a reversal structure as a continuation pattern. Okay, that makes it a strong demand area, right? And it looks like this: drop-based rally and rally-based rally combination, right? Similarly, price is said to be forming a strong supply when a series of price structures are created as rally-based drop and drop-based drop. Right, friends? So here, price is falling down from a expensive area to a cheaper area. Price created basings to decide whether price is cheap or expensive, and then it made a decision, right? And the price moved up. That price is cheap here, thus creating this reversal structure, right? Then what happened? Then again, price went into a decision-making process to decide whether the previous decision was made was right or wrong, right? And here, it was decided that price is cheap, and price continued in the direction, right? And this structure is rally-based rally. So drop-based rally reversal plus rally-based rally, which is a continuation. Okay, this is a double confirmation of your demand area. Correct? Similarly, on the right, you have a rally, base, and a drop, which is a reversal structure of supply, followed by, right, price made a decision here that price is expensive, okay, and price formed a drop here, moving to a cheaper area. Again, you have another confirmation here that price is still expensive and price formed as continuation structure. So you have a reversal structure, rally based drop, followed by a continuation structure. Okay, this is also a double confirmation of an area of price where you have strong supply in force. Right? Friends, have you understood this concept? The combination of reversal and continuation? Anybody having any doubt? Okay. So I have few additional notes for you, friends. Okay. One is, even during accumulation distribution session, okay, I have stressed on this point. So you have demands and supplies getting formed on various time frames, right, on a chart, right? You have yearly, monthly, quarterly, half yearly, daily, hourly, right, like that. You have different time frames, right? Okay, and you will now find demands and supplies on all those charts. Okay, so the takeaway for you is, we are stressing that you need to always remember that the time element attached to the demands or supply, right, they have lot of power. That means higher the time frame demand or supply, right, they have high power for rejecting the price from that area, to give reactions when price visits those areas, right? So higher the time frame of the demand or supply, higher is the probability of price getting rejected from that. Okay, remember this always. So we said consolidation against time is powerful, right? Second, higher the time frame demand or supply, greater is the power of the move when price visits that area. While trading on lower time frames, it will be very useful to take trades with coinciding levels of higher time frames with lower risk and higher RR. See, we'll depth of this subject, right, will be covered in a multiple time frame session, which is going to come up in the series. Don't worry about it. For now, you just remember, if you're going lower the time frame, right, of demand supply to trade on, you should always ensure that demand or supply on the lower time frame is coinciding with a higher time frame demand or supply. Let's say if you're taking a daily demand, ensure that it is a part of a weekly demand, okay, or a monthly demand as well. Okay, if you have such levels, your levels will work very good. Okay. Second is, when you have two demands closer to each other. Okay, let's say you have two demands, right? You have two demands. Okay, you have two demands pretty close to each other. Okay, this is a demand zone and this is also a demand zone. When price is coming back, when these two zones are pretty close to each other, always look to trade this lower level. Give importance to the lower level. That's what it means as level near level. Okay. Similarly, in case of supply zones, right? Price is forming supply. Okay, this is a base. Okay. When these two zones are very close to each other, look to, and price is coming up. Okay. Give more prominence to the level that is above this level, when these two are very close to each other. All right. This is an additional note I want to give to you tonight. The third one is, demand or supplies are preferred to trade on first retest. So whenever you find demands or supplies on a chart, right, price is going to revisit that area, right, So because you want to become a retest trader. So when price is retesting that level, you give more preference to the demand or supply which are fresh in nature. Okay, so always give relevance to the first retest. Hemant has a question. No counter trend make probability make higher. Hemant, we have lot more to cover in the sessions, right? So we'll talk about trend, counter trends, all that further. Today's session, friends, you need to know is just a definition to demand and supply. Okay, just remember this. We're just defining demand and supply in this session. So we're just talking about the price structure, that is how a demand looks, how supply looks. All right, and this is a basic session, and to get to that we have to cover a lot of subject, right? So this is just a very basic session, and it gives you a definition of a demand and supply. Okay, we have a lot more elements of trend and all those things coming up with respect to trading part. So just be patient, till we cover those subjects. All right, Hemant. So I have a homework for you. Identify demand and supply zones at various areas of few scripts on the charts across different time frames. Okay, just pick up 2-3 time frames. Okay, and pick and identify demand and supply zones on charts. Okay, second is demand and supply means drop based rally, rally based drop, rally based rally, and drop based drop with respect to reversal structures as well as continuation structure. Identify them on a chart. Okay, second is mark some demands and supplies, okay, on the chart, and observe in the live market when price is visiting those demands or supplies. Okay, friends, and make some notes like of however I've showed you on the chart, right? How you are identifying the move in, base, move out, rally, base, drop, etc., right? Mark all that on the chart and observe in the live market how price is coming to that zone, whether it is forming a new supply or demand as it is coming to your level. Okay, and how the price is moving from your behaving at your demand or supply. Okay, do this as a homework for this after the session, and share the results with your mentor, and be ready for the next session, friends. Okay, are you all clear with the homework, friends? Any doubts anybody having in this session? I know I'm extremely sorry, friends. I'm overshot today's session by 44 minutes so far. It never happened before. But I hope there was some value created by the way of discussion today. Okay. Thank you, friends. So that brings us to the end of today's session. Thank you very much. If you have any comments, critical or appreciation, please send your valuable feedback to the stoplosstraders@gmail.com. We'll be happy to receive them and make changes to our program. Right? Thank you so much, friends. Good night. Okay, AP has a question. Many times we see rally just followed by drop, or just the opposite without any base. Will you call it reversal structure? AP, that's also one type of reversal structure called pivot. Okay, those, let's say for example you are seeing such a structure on a daily chart. Okay, you have a rally and you have a drop. Okay, now on that time frame it is just a pivot, but that is also a reversal structure, because you need to here look at the reversal of price direction, okay, by price action. But to find a base, AP, you will find it at a time frame lower than the pivot time frame. All right, you will definitely find a base at the lower time frame at that reversal. AP, did I answer your question? It's still a reversal structure, valid. So reversal is with respect to the direction of how price moved in and moved out from a price point. Very simple. AP, can I get a confirmation from you? Okay. AP has a question, rally gap rally or drop gap rally, are they count structure? So AP, you will have to wait for a little time, okay? We have a separate bonus session on gap. Okay. To answer you right now, yes, that is also a continuation structure. Okay. That much I can give you at this moment. For the remaining, you will have to go through that particular session to get no more value of that. Okay. Yeah. So once again, friends, I apologize for the more time that I took for this session. I hope no there was a value created and the time was well spent. Okay. Good night, friends. Please do send your feedbacks. Good night. Thank you, friends.